3 signals say Bitcoin could be bottoming. The last 48 hours painted the story. And no, by bottoming, if you're new, I don't mean it's over for Bitcoin. I mean it's reaching the end of its downward trend, potentially. Because in the last 48 hours, Bitcoin dumped hard, we saw liquidations spiked, and then we saw the price snap straight back towards $93,000. That didn't come from hope, wishful thinking. It came from structure. A clean reset that flushed leverage and pulled in real buyers. So today, we're going inside that structure, the real mechanics behind this reset, and the line forming right under the market that could define the next cycle. This is the story of a 90K Bitcoin, the new line Wall Street refuses to break. So stay with me until the end, because once you see how these 3 signals connect, you'll understand why this zone matters so much. So let's get into it. We know every Bitcoin cycle has a rhythm, big rallies, violent pullbacks, and then the moment that clears the system, clears the runway. And we see from 125,000 down to 80,000 was about 35%, the same cycle as nearly every major bull market correction on record. And Glassnode shows 9 separate 30 to 40% retraces inside major uptrends, each one wiping out leverage and handing coins back to stronger hands. So this drop has carried that same signature. Volume on November 21st, wick hit multi-month highs. Then came the reclaim. Price bounced back into $92,000 to $93,000 within a day, which is the same demand zone that had anchored the prior rally. And that move wasn't random. It marked where new capital defended the line. So when people talk about volatility, remember this pattern. A 30% flush is how Bitcoin reloads. And each candle in that move is a redistribution to true believers. And if you've been around, you know this. And what we've seen so far, our markets don't bottom when new buyers rush in. They bottom when forced sellers run out of ammo. And over the last month, OG wallet outflows to exchanges dropped to their lowest level since 2022. Whales, who were de-risking above $100,000, slowed down once price entered the $80,000 to $90,000 band. And funding on major derivative venues flipped from positive to neutral. So this means the crowd that was paying premiums to stay long got flushed. Shorts got paid, and both sides leveled out. So from that base, you see the first wave of initiative buying, traders adding exposure with defined stop outs at $84,000 and targets back towards $100,000. That is classic exhaustion behavior. It's the same pattern that's marked bottoms in 2022 and April last year of 2024. A huge volume spike, a reclaim, and then silence. And this is where Wall Street flips the switch. Because while traders have fought through panic candles, something huge happened quietly behind the scenes, as it always does. Wall Street just made Bitcoin easier to buy than ever before. I lightly covered this in yesterday's video, but essentially what we've seen is Vanguard switch on Bitcoin ETF trading across its entire brokerage firm. More than 50 million accounts now have a live buy button that didn't exist a few weeks before. That's decades of conservative retirement money that suddenly has instant access to the asset they used to call too risky. How times have changed. Bank of America has set new guidance to 15,000 advisors, an army. And starting in January, those desks can recommend a 1% to 4% Bitcoin allocation to client portfolios. Incredible.
Huge news today for crypto. The Bank of America officially recommends clients put up to 4% of their portfolio in Bitcoin and crypto. Here's the exact language you need to know as a crypto investor from CEO of Bitwise, Hunter Horsley. He says, huge news. Bank of America, private bank and wealth management, one of the largest in the country, they control over $2 trillion, announced that they will allow advisors to allocate 1% to 4% to Bitcoin starting in January.
That means families with private bank relationships now have a compliant way to add Bitcoin without having to open a separate exchange account and go through the hassle of setting up their own wallet, though it is preferential. But as we know, it's the beginning of reaching them with Bitcoin's message. So for now, I'm excited for that. And when a client allocation hits a model portfolio, we know those flows execute no matter what X is saying. So yes, these are quiet changes, and we haven't seen their full effect ricochet across the crypto market or Bitcoin's price yet, but they will slowly reshape the market and Bitcoin's price into the future. So what we have here is a situation where, while retail traders have been panicking, you know how I feel about them, institutions have been wiring access, while fear has been sweeping the internet. The biggest distribution channels in finance flipped from off to on. This is the second major structural change of the cycle. Huge. So we see Bitcoin isn't just a trade anymore. It's turning into standard portfolio infrastructure. And that shift, okay, this shift is happening right in the middle of maximum fear. So, all right, now that the access doors are open, let's move into the next signal, the one coming straight from policy and politics, which is probably one of my favorite signals, as I believe they are larger macro forces that ultimately have such a huge impact on Bitcoin and the crypto market and into the future. So what's happened? Well, Jerome Powell's term ends May of 2026, and prediction markets now show Kevin Hassett leading as Trump's preferred replacement. And for those of you who don't know who he is, his resume includes Coinbase advisory work and millions in coin stock. So a quick translation for you is this means he's dovish and a crypto-sympathetic Fed candidate. Basically, he's on our side. And we hear from Arthur Hayes, who broke it down in his 47 essay. He tends to give his essays very interesting names. Anyway, he explains how Trump could lock in a voting majority inside the Fed's Board of Governors long before that nomination.
I think that we are at the end of the beginning of this cycle, and the massive amounts of crazy bull market money printing is ahead of us. Now we're basically in this transition period where, Team Trump and his Republican Party are going to print a ton of money to try to win an election.
The rates are too high, Scott.
U.S. President Trump and his attack dog, U.S. Treasury Secretary Scott Bessent, are trying to take over the Federal Reserve.
And if you don't get it fixed fast, I'm going to fire your ass, okay?
I'm not sure if he was joking or how serious he was about it. He said he loves everything you're doing, but if you don't get the Fed to lower interest rates soon, he might fire your butt.
I think that the fireworks are just beginning in terms of what assets can do. Bitcoin is the last free market smoke alarm of liquidity.
In a former life, by the way, he was a top trader for Citigroup. So, Arthur, it's great to get your analysis here.
It's pure political arithmetic. Whoever controls the votes controls the policy. And since 1913, every US president has eventually gotten the monetary stance they pushed for. So there's no reason to believe it shouldn't be the same for Trump. And we're already seeing the early tremors of it. Overnight repo usage we see spiked hard last week, and that's the plumbing that tells you banks are short on cash.
We started to see these massive rises in the 7-day daily exchange volume, and a lot of people believe that it's got something to do with transitioning from QT into QE with the overnight repurchase agreements spiking.
And that the Fed is about to step in with more liquidity. Each time this market has seen a move like this, which has been in 2020 and 2023, Bitcoin caught the signal first. And if we add in one more layer, that is global liquidity, the combined balance sheet of the Fed, the ECB, BOJ, and the PBOC has already expanded roughly 1.7 trillion since mid-2024. And this is according to Bloomberg's Global Liquidity Monitor. So this is the biggest synchronized increase since the COVID stimulus period. And if we put these pieces together, you get the third major signal forming around this market: political pressure for cheaper credit, technical stress in funding markets, and a global wave of new liquidity. Bitcoin doesn't wait for a press conference to react. It moves the moment liquidity returns. And that's what's starting right now. So, all right, with the macro engine warming up, let's now move over and talk about how fear in crypto equities usually marks the turning point. We know every cycle creates a few moments where the fear breaks the math. And this month gave us one of those scenarios. As I mentioned earlier, Strategy's market cap dropped below the value of Bitcoin it holds, even after subtracting debt. So this means the market was literally valuing the company's core software business and treasury operation at less than zero. Moments like these are rare. They happen when panic outpaces logic. When traders stop doing math and start reacting. In 2018, miners traded at valuations that implied bankruptcy, while hash rates kept rising. And in 2022, publicly listed crypto companies were priced for collapse just months before the biggest adoption wave in history. So now, this year in 2025, we're watching the same movie play out again. Fear, creating a temporary discount big enough for smart money to quietly step in. Dislocations like this don't last long. They're how markets reset. They flush out leveraged speculators and transfer assets back to holders who actually understand what they own and won't panic sell at the first sign of turbulence. Strategy's discount isn't just a company story. It's a temperature check for sentiment. And when something that tightly linked to Bitcoin trades below the value of its own treasury, it shows you the level of emotional exhaustion in the system. That exhaustion is what allows a new base to form. But all right, with the fear side of the story clear, let's zoom back out. Because while everyone has been panicking, hopefully not you, Arthur Hayes and a few macro analysts were pointing at something much bigger. That is, the 90K line and the structure behind it. If you step back and look at how every signal we've talked about lands in the same place. Pullback found support right inside the 80 to 90K $1,000 zone. Whales stopped selling there, funding reset to neutral, and institutional access through Vanguard and Bank of America went live, while sentiment hit peak fear. And macro liquidity, from overnight repo spikes to new credit programs, all started pointing higher. All those streams meet at one line. That is $90,000. It's not just a number on a chart. It's the area where forced sellers ran out, where structural demand stepped in, and where new capital flows can anchor. Every major cycle has a level like this. In 2017, it was $6,000. In 2021, it was $30,000. And this cycle, it's $90,000. The point institutions defend because they're finally in the trade. And you can see it in behavior. ETF inflows turned positive right as the price reclaimed that zone. Perpetual funding stayed stable, which tells you the buying wasn't reckless, and the emotional wave online flipped from panic to confusion, the exact midpoint before confidence returns. And that's what makes $90,000 different. It isn't a retail floor, it's Wall Street's entry. Think of this level as the new liquidity benchmark. When Bitcoin sits above it, new ETF allocations and institutional models stay engaged. And when it dips towards it, long-term capital reloads. That kind of behavior builds a base that lasts for years, not just weeks. So while the headlines talk about chop, what's actually forming is structure, a support range built out of flushed leverage, new access, and fresh liquidity. The last two cycles had to wait for institutions to arrive, and this one already has them defending the line. But all right, let's close this out by zooming back to what that structure really says about conviction, timing, and where Bitcoin could go from here. So as we close out, let's talk about what the reset really means. Because the last few weeks have been extremely chaotic on the surface, as they were supposed to. This is how bull cycles reset. And I would add, this is how the whales, now the new masters in the market, pull the strings to make sure they still get Bitcoin on sale. We know the weak hands have to get flushed out. Liquidity has to shift from panic to planning, and access widens. While behind the scenes, the macro environment turns quietly supportive. And this week in particular, Strategy's storm sparked the conversation. The market's behavior afterward revealed the real signal. Everything beneath that chaos, from ETF flows to global policy, points to one truth. Bitcoin's structure is strengthened. $90,000 has become the new line. It's where fear was absorbed, where Wall Street entered, and where the next leg potentially begins. It won't go up in a straight line. And don't mistake this for saying Bitcoin can never go below $90,000 again. But keep an eye on that level, because how price behaves there will tell you everything about where we're headed. Remember, conviction shows up in actions, not tweets. Over the past month, we've watched that conviction build in real time. So that's the story of this cycle. A market that looks uncertain on the surface, but is quietly laying the foundation for the next expansion. So if this helped you see the bigger picture, share it with someone who still thinks the bottom is breaking. And subscribe for the next episode, because we are just getting started on the macro turn that could define the rest of the decade. I love you guys so much, and I'll catch you guys here in my video tomorrow. Take care.